and welcome to this evening's open house Q&A. As I'm starting this off, I could see that the attendees are still rolling in, so I don't want to delay too much, but I do want these folks to get a chance to log in here and join us. And welcome David, Brian, Herschel. Herschel, you're a regular. You come in. I don't think you've missed one yet. Nathan, welcome. Rick, Ron, Prem, Bert out there in the Tampa Bay area. Bert, are you still out there in Tampa Bay? We have, I'm just going to do a couple of shout outs. We have Paul Farley. Paul, how long have you been following now? It's well over 10 years. I know that. And you're another one, you never miss any. Mike, Neil, Paul again, Hosek and Peter, Philip, Richard, Robert West, welcome. Sean, wow, look at this. People are still coming in. All right, well, I'm going to kick things off here as I usually do, starting with the indices, and then before, because I don't want to keep people in suspense too long, I have an announcement to make here, and I'm just looking to see if we have Dominic on the line here. Dominic, if you are on, send me a text, because there's too many names to scroll through here. But right after I get through analyzing the major markets, I'm going to make an announcement. And then what we'll do is we'll get into the rapid fire stock analysis segment. Okay, so let's start off with the Dow diamonds, okay? And I'm going to show you, it's more or less what we do on the Monday after Friday expiration. This is the only time of the month where I do a more or less a recap of the previous week's market report. And you can see this is the line that I drew. Let me zoom in a little bit more for you here. This is the line that I drew last Friday, forecasting that we would pull back in the Dow. Now, what I want people to know is that the Dow and the Qs representing the tech sector, are moving almost opposite, because there's still a lot of money coming into the Qs. But don't be fooled by today's green candle right here. And reason for that is on Friday we had a bearish engulfing pattern here. See that as I highlight that with my cursor. Today, even though it was a green candle, we had a lower high and a lower low. And notice the volume down here. I don't want to draw too many lines because I keep the lines up till next Friday's report. Okay, but look at the volume is increasing, even though it's a green candle, as this stochastics and the CCI are now crossing with a sell signal. So again, don't be fooled by the green candle. The green candle basically tells us that the market closed higher than where it opened. That's all that means, is that the market closed higher than the opening price. But we still have a lower high, lower low, okay? And I just got a text. Let me see if that's Dominic here, because I want, oh, Mike, okay. All right, good. All right, so I'm gonna talk about what we're doing here. Again, Mike, hold on to your hat there. We're gonna make that announcement. All right, so I still believe that we're going to pull back towards the end of the week on the diamonds, and be careful with any new long positions, okay? Just be really careful, because what the charts are telling us now is really to be defensive. It's not telling us to get completely out of all of our positions, but it is telling us be defensive. Right now, I'm going to hop right to the Qs, because last week I said, you can see this little this uptick here. I said that early in the week the Qs would rally, will go up before pulling back. Now that's happened already. So today, not only did we hit my target pivot point right there, see that? Not only did we hit that, but we blew that away, and now it looks like we're getting ready to test this high from back here. Now again, different than what we just saw on the diamonds, isn't it? we see a higher low, a higher high, a strong candle with higher volumes. So the Qs is telling us the buyers are still coming in. See that? Now, what I want everyone to keep an eye on with the Qs, especially if you have any long positions in the tech sector, is you really need to pay very close attention to the CCI down here, more so than the stochastics. Okay, let me review this for you. If I'm going to throw out a scenario, okay, if the Qs go on to break out of the high here, or at least show a higher high, doesn't even have to have a full breakout. All it has to do is show a higher high. Keep an eye on the CCI. I'm going to erase this because I don't want to, again, I don't want to mark this up too much. Because if we go into a higher high on the NASDAQ, but we show a lower high, let's play this out. Let's say that the NASDAQ goes higher and the CCI goes higher, which is what we would expect. The key is whether or not the CCI is going to show a higher high than what we had back here on the high for the CCI. All right. If we do not see a higher high, then that's going to be a very significant signal known as a negative divergence. Because especially commodity traders, the most valuable signal that you're going to get, whether it be a buy or a sell, is a divergence, a price divergence from the indicator itself. All right, now if you have any questions on that moving forward, then type them in and I'll do my best to get them in. Welcome, Dr. Billy. I want to highlight Dr. Billy there. Okay, so that's the Qs. We have resistance up here. I'm not going to draw the line because I'll mark that next Friday or this Friday when I do the market report. All right, let's move on. Russell 2000. What did I say? For those of you following the weekly market report, what did I say about the Russell? I said that we would most likely move lower. And look what's happened today, right? I have to zoom in a little bit more because this is really significant stuff here. All right, I'm going to test the audience here. Let's see if I can go to the Q&A. I'm going to ask a question of the audience, and I'm going to see who can answer it. And I think some people are already anticipating this. All right, this is a red candle that follows this green candle. What two-day pattern is formed here today? Can anyone tell me? All right, there you go. Jim and Ron, and actually Todd, you're right as well. Todd said a spinning top. Yes, that is a spinning top. A spinning top is read very much like a doji, where it's a sign of indecision. All right, you usually find spinning tops at pivot points. But Jim hit the nail on the head saying bearish harami. And Ron confirmed that as well. Todd, what's a tweezer? I never heard of that one before. A tweezer. I have to look that up. You piqued my curiosity there. Anyway, a bearish harami is read in a similar way to the bearish engulfing pattern. While the red is not completely engulfing the previous green body, the red is falling within the opening and the close of the previous green body. Now, we have, lots of different people that talk about candle patterns, and Steve Nissan, self-proclaimed introducing candles to the West. It might have a different, I guess you could say, label as to the way I look at it. But when I talk about candles, I'm not trying to redefine the definitions or the patterns. I'm just, listen, after 40 years of reading charts over and over, I started reading and studying charts even before I came down to Wall Street. I actually started studying candle charting patterns when I was in the Navy floating aboard the USS America. I knew I was eventually coming to Wall Street, but I didn't have any experience. So I started studying long before I came to Wall Street. And at the time, candle patterns were not very popular. It was more or less the Elliott wave that was popular, and bar charts. Bar charts were more or less replaced with candles. But you read bar charts the same way as a candle. The only thing is a candle chart is going to be colored in. How many of you, just by show of hands, how many of you actually used bar charts in the past? Just click on the hand button there. Let me see, how many of you? Eugene, did your hand just go up or did you leave it up? Francis? Okay, a couple of people. Dave? Okay, yeah, so we got some old timers there. All right, Stephen, Rick, yeah. So when we were reading bar charts, there, the definitions of engulfing patterns weren't made popular yet. But for instance, if you saw a wide difference between the hash marks on the bar chart, but then you had a more narrow difference between the open and the close, we always saw that as a bearish pattern, because what that meant was, and if you combine the high and the low here to define this, we have a lower high and a lower low, which, by the way, is the definition of a pivot point, right? Back here, let me give you a little bit more of an education, right? This red candle, notice this one is also a bearish harami. It falls within the body of this big green candle. Here is a bullish engulfing pattern. So a bullish engulfing pattern followed by a gap up, big green candle followed by a bearish harami right here. This candle is showing a higher low, but it is showing a lower high. Who can tell me what that is? I mentioned it before. Who can tell me what that is? Go ahead. And let's see. I know there's a little bit of a delay. No, it's not a hammer, not a bull flag. That is known as a half signal. A lot of people don't know about that. The market technicians, the charted market technicians, that was actually one of the test questions on part 2 of the MTA exam for becoming a market technician. There was 3 parts that you had to go through. It was pretty intense, but a half signal is when you have an up leg with a higher low but a lower high. That's a half signal, and keep that in mind as we look at your individual stocks. Let's see how many half signals we can identify, which is not necessarily a sell signal in and of itself, but it is a caution flag when you see half signals, right? So what's my forecast for the rest of the week? I'm gonna hold true to what it was on Friday. I think we're still going to pull back on the Russell 2000, all right, because it's more small cap. All right, we looked at the diamonds, we looked at the Qs. Did we look at the Qs? Let's see. I just want to make sure. No, yeah, we did look at the Qs. But one thing I left out on the Qs, I want to show you. I mentioned this on the weekly market report. You really have to watch this, folks. This is the monthly candles of the Qs. Now notice how overbought the CCI is on the monthly chart, and notice how wide of a divergence we have from the moving average. Now this is a monthly chart, so when I switch to a monthly, my moving average is set at 20 period. So depending on which period I'm switching to on the chart, it's going to represent that period. So if this is a monthly chart and that's a 20 period moving average, and that's a 20-month moving average. You see, if we go back 20 years now, that is the widest divergence we've seen, not just in 20 years, but I don't have more data on this chart, but this could very well be the widest divergence that we've seen in the history of the NASDAQ. So does that mean you shouldn't buy anything? No, there's going to be different stocks that are still going to keep going higher, even if the general markets pull back. But it does tell you, use extreme caution. If you are long any tech stocks, you just have to do a really good job of trailing your stops. And the higher it goes and the more vertical this angle is, the more aggressive you need to be on trailing your stops. So for instance, if you're going to a daily chart, okay, and you're trailing your stop below the 20 period moving average here, you might want to trail your stop below the last couple of days average low, or below the previous day's low. See how you get more aggressive at trailing your stop, okay? So again, keep that in mind. I didn't mention that on the cues, but I mentioned it now. All right, let's look at the spiders. All right, I said we would go lower. We are showing a bullish engulfing pattern here. All right, now that doesn't mean I'm going to be wrong by the end of the week, or I should say it doesn't mean the charts are going to be wrong, but that is a bullish engulfing pattern that is on lower volume. You see that? That's interesting because we have a bullish engulfing pattern that basically breached by a hair over this resistance high. But normally on a true breakout, and this is why you have to be, again, extra cautious, on a true breakout, you have usually you see a dramatic increase in volume. Now, the S&P 500 obviously representing 500 stocks, you would think that there would be more volume on that breakout. We're not seeing it, all right? The other thing we're not seeing is a higher high on the CCI. Look, we're seeing a slightly lower high on this higher price high. See that? So there's your negative divergence. All right, I'm going to erase that because I don't want to, again, have that line up there, and then all of a sudden next week people looking at the recording and saying, AJ, where'd that line come from? All right, so anyway, that's the spiders. I'm still going to hold to a pullback. I am actually looking for short positions for option traders, not just in the spiders, but in the Qs as well. And I'm sure when we start getting to analyzing your stocks, I am absolutely certain someone's going to bring up a high flying tech stock. So wait for that. All right, now, finally, the VIX. Okay, the VIX is, in my opinion, still a good leading indicator. And even though we had a red candle here, it is still oversold on the VIX. We did not get a pivot point just yet, but opposite from what we saw on the spiders, we have a lower price low. See this? Lower low compared to the low that we have back here on the 6th of July, but we have a higher low registering on the CCI. See this? So that is a positive divergence. It only makes sense because the VIX is inversely related to the S&P. So if we have a negative divergence on the spiders, we're going to have a positive divergence on the VIX. So there you go. All right, now let me make the quick announcement. Let me do a last check. All right, we have Mike on from Market Rebellion. I got off the phone today with Dirk, who's one of the 3 partners from Market Rebellion. For those of you who watch CNBC, you may be familiar with a show called Fast Money, where John Nigerian and his brother Pete are the market rebels. They've created a company called Market Rebellion, and I am joining Market Rebellion as the chief technical analyst for that company. And we are going to be issuing a major promo where we're going to be promoting my trade alert services through Market Rebellion. Now, the main difference, for those of you who are subscribers already to my trade alert service, the main difference between what I'm offering, and I'm not going to be offering anymore, but for those who are grandfathered in, the main difference is that Market Rebellion is going to be offering an annual subscription, and they're going to be marketing additional educational products, particularly a technical analysis course that's web-based that you can subscribe to. All right, so if you're not a subscriber already and you're thinking about becoming a follower, let me give you a couple of ideas. Number one, type in your email address and I will forward that on to our team where you'll get a follow-up call from them. I promise you, you're not going to get any hard selling from these folks. That's like a major thing with me. I don't like to be hard sold on anything. Therefore, I'd rather, have my product handled in a way where it's a needs offering, not so much a, hey, you got to buy this thing, right? Laura, you're one of the coaching students, and Laura's been first time I met Laura was down in Miami at one of our live events down there. And Laura, by the way, we have to schedule some time this week because we don't want to get sidetracked with that. All right, so if you are interested, just type in your email address, and I will have someone from our team give you a call. And the other thing is, when this is full blown in high gear, they're most likely going to be doing some television spots on CNBC to promote my services. And the reason I tell you that is because once that happens, it's going to be almost a guarantee that I'll become untouchable at that point, and it's going to be harder to get in touch with me with any kind of one-on-one coaching. So if you have an interest in me being your personal coach, then again, put your email address, but highlight in the notes field there that you have an interest, because basically what I'm telling you is beat the rush. And we're a ways away from that television campaign, but I'm just giving you a heads up now, because once it's out there, then it's like anything else. It's harder to get in touch with John Nigerian now than ever before because he's become so popular. And same thing with Pete. And so I have a great passion for teaching people. I want people to make money. I want people to learn how to read the charts and how to manage risk. So that's the big announcement. Okay. Thank you, Don. I will forward that on. Thank you, Francis. I'll absolutely forward your email on. And who else? Mike there. Thank you. Yeah, we have a bunch of people putting their email addresses on. So again, stay tuned. Also, for the members of Market Rebellion, we're going to be doing a lot of web-based Q&As, all right, where folks like Bill Johnson, who I've known for, well over 2 decades, Bill might host a Q&A session intermittent between my open house here. I'll still keep doing the open house, but you'll have more access to Q&A forums, okay? All right, so enough of that. Let's get right into your stock symbols. All right, so okay, I still see a lot of people typing in their emails there. All right, so what we're going to do is I'm going to ask those who put in stock symbols to type them in again. Now, if because it's getting washed through the scrolling effect here of the Q&A box. If I don't recognize you, keep typing in your stock symbol. Now, the only thing I ask is that when you type in a stock symbol, like Laura, you typed in the stock symbol, but you didn't type in what your idea is. So what I mean by that is, if you type in a stock symbol like Amazon, or I'm going to type in Amazon for Laura, but let me know, do you have a position? Are you thinking about a position? Do you have a position? Maybe you're thinking about getting out of a position. Let me know. All right, now, first thing, Amazon. All right, I see that. Okay, so Amazon, incredible bullish candle there. It's not bullish engulfing, but incredible bullish candle, right? Now, look at that. This is showing super high volume today. The stock was up $234. Amazing, right? Amazon is showing record high. There's vaccine hopes, right? Record high for NASDAQ vaccine hopes, and there's a fuel binge. That's one of the headlines here. Okay. Now, one of the things about Amazon is look at the price per share, right? You're talking $3,200 a share. They haven't announced a split yet, right? Now, why is it that you have a stock like Amazon trading like that and there's still massive amounts of volume? That's because the institutions are able to move a lot of money without moving the stock necessarily. Now, this stock happened to be moved today in a big way, but institutions can move many, many millions of dollars without actually worried about their own order moving the stock, right? Now, notice the hinge here on the stochastics. See that? It's bouncing off of the 20-period moving average right here after showing a bearish engulfing pattern on Friday. See that? So does that mean it's not going to go lower? No, it means that this basically is a jolt of the buyers coming in. Notice the CCI. It went briefly below the 0 line, and went right back up over the momentum line. Now, for those of you who are trading Amazon, most likely you're using options to get your leverage, because even someone with a $5,000 account can trade Amazon, but you'd most likely be using credit call spreads or debit put spreads, whatever it may be. You could trade debit and credit vertical spreads with very little money in your account, even though Amazon is trading just under $3,200 a share. You see why options now is becoming so attractive to people? Because they're figuring out, wow, even with a small account, I could participate in volatility in Amazon. Let me give you an example without making this more or less a trade recommendation. Right? Let's say that you're bullish on Amazon, all right? But you only have a small amount of money in your account, all right? Let's look at this for a second. Let me scroll down through all these strike prices. Don't be intimidated by this, okay? Let's say you have $1,000, okay? You have $1,000, and what you want to do is you want to go long the stock. Again, this is just an example, not a recommendation, because there's a lot you have to know about trading vertical spreads. I'm giving you an example to show you why someone with even $1,000 in their trading account can trade Amazon if they have option approval in their account. Right here, I'm going to highlight this. This is the 3150, 3160 calls. Now, I can go in there and buy, now it's a wide spread, but let's say I buy these for 225. I split the market. I buy these for 225, and I simultaneously sell these for 223. Or let's say I don't even get that high of a price. I buy these for 225 and I sell these for 220. Again, I'm splitting the market. Now, again, without getting too far into option theory and strategy, the amount of money that would cost me if I did that, if I bought this one for 225 and sold that one for 220, I would have to lay out $5 times 100, because there's $100 in each contract, 100 shares in each contract. I would have to lay out $500. Now, if Amazon stays over 3160 in the next 32 days, it stays over 3160, that $5 will return $10. So I will have made 100% on my money, again, if the stock stays over 3160. So the only time you would do that is if you're bullish on the stock. Now, what's the most I could lose if it goes down below 3150 and stays there? Well, the most I could lose is $500. See, unlike someone who buys the stock and spends, $32,000 or $320,000. I know people that trade this crazy. They'll buy the stock and buy lots of it because they have a lot of money in their account. Now, again, if you buy a vertical spread, the most you could lose on that vertical spread is what you pay for the spread. That's all. I'm not going to go too far into this because I don't want this to turn into an option, 1 hour discussion on options. I'm just giving you a little taste as to why options are becoming more attractive now more than ever, because it allows the little guy to be able to take a small position in a very big stock and still make money, or have the potential to make a lot of money and good, strong returns. Okay. So Laura, I don't know what your position is going to be on that, but be really careful if you do take that position, and I will go ahead and talk to you about that. Question from Mike Todd. AJ, been wanting to do the personal coach deal. I'm from Vegas. Oh, okay, Todd. All right. So I'm going to have one of the sales folks. I don't know who your relationship manager is there, but I'll pass that on to them, and we'll set that personal coaching session up with you. Okay. All right. I'm scrolling through email addresses and getting to Sean. Sean, MRVL. Is that Marvel Comics? Let me see. MRVL. Is that Marvel? Yeah, that is. I think so, right? All right. Let's see. And here's a stock, obviously trading a lot less than what we just saw on Amazon. And Sean is saying I am short at 37.77. He has a stop at 38.67, but has a target on the downside of 34. All right, so I'm going to look at this. Now, one of the things you have to watch out for, Todd, is Sean, is that you're short it pretty close to where it is right now. So as of now, at the close, the stock is 11 cents against your short. All right. Now you have a stop at 38.67. Now I'd be curious as to know how you came up with that stop, because I don't see any resistance or anything on the chart that tells me that's the proper place to put a stop, other than it's close to where you short it. Now, normally when you are short a stock, it's not a long-term position. It's a short-term, time strategy, more or less, where you're looking for a jolt down, right? Normally, when I short a stock, I try to put my stop below. I try to put my buy stop above a key resistance area. Now, on this one, the resistance is right there around 39.34. So what could happen on this one, Sean, is the stock could actually go up to test resistance, trigger your buy stop. You're now out of the position, and guess what? It goes right back down. So, I don't want you to put yourself in a higher risk position, but normally you would put your stop above, a buy stop above resistance. So keep that in mind. Now, the other thing is we see an engulfing pattern here, it looks like. No, not quite. No, that's the green candle, but not an engulfing pattern. But we see a green candle on higher volume, right? The thing is, you got mixed signals, basically. Your target of 34 is also interesting, because I'm guessing that is going to be close to where this gap is. I think your target might be too low, and here's why. Let me see how good my eyesight is. The high on this day is 35.39, it looks like. The low on this day is 35.63. So you have a very small gap here. You see that? By pennies, there's a gap. That would be my target if I was short it. Why? Because if you follow the gap fill rules or the gap trading rules, 80% of the time gaps fill. What does that mean? It means 80% of the time this gap, it'll come down there. Now here's the other reason why I would have that as my target. 80% of the time after a gap fills, prices generally reverse. So what could happen is your target is 34, it hits 35.30, bounces, never hits your target, and you missed out on taking a small profit. You see? So I think, again, your stop is too low and your target is too low. If you shift that a little bit, widen that out a bit, I think you'll be better. You'll be in better position for that. All right, so hopefully that helps you. Now, finally, before I move on, let's look at the weekly chart on this one. Yeah, weekly chart, again, the weekly chart is basically confirming that a short position would be in order, because look at the weekly price divergence from that moving average. You see that? Pretty wide. So I like your idea. I think you just need some fine tuning on that. And if it looks like you want to hold the position, a prolonged position, what you could do is hold the short position and sell a put. I don't know how well versed you are on options, but if you short and you want to hold it for a little while, you could sell a put to take in some credit. So selling a put obligates you to buy the stock lower, which you'd be okay to do anyway, or be willing to do if you short it. Okay. All right. Now, Philip, welcome, Philip. Philip is another regular attendee here. Morgan Stanley, MS. Let's see what the position is. No position. Thinking of writing cash secured puts. All right. Now, be careful. I just happen to be on the weekly chart on this one. A cash secure put is when you are putting up cash and enough of it to buy the stock at a lower price. Now, The stock is already overextended. Look at the weekly chart, and then I'll switch to the daily. Notice this was a weekly gap. See that? Last week the gap filled, right? So again, fulfilling that 80-20 rule on the gap strategy. 80% of the time gaps fill. All right, what's the second half of that? 80% of the time after gaps fill, what happens? Prices usually reverse. So while I like your idea of taking in cash, I think you're a little bit too premature and would probably wind up taking in a lot more money if you waited a bit, right? Because you're thinking about selling the $50 puts. Now, all right, $50. If you sell a $50 put, chances are you're going to wind up with the stock. Why? Because now I'm going to switch to the daily chart. Because look at the 20 period moving average on the daily. Even though the stock hit and filled that gap, today was a lower high, lower low, right? Lower high, lower low. You now have the stochastics going lower and the CCI crossed with a sell signal. So if you sell a $50 put and the stock continues to drop, you're going to wind up being long the stock. Now, if you're okay with buying it at 50 and getting paid to do it at 50, then go right ahead. But like I said before, the technical signals are telling us wait. Why? Because the price is going up, volume is dropping. Who could tell me what that means? It's a test question. If the price is going up, but the volume is dropping, what does that tell us about the motivation level of the buyers? Let's see, scroll down. Any answers yet? Yeah, buyers are tired. Thank you, Colleen. Bearish divergence, exactly. Thank you, Stephen. Francis saying waning. That's right. The buyers are waning. Negative divergence. Todd, you're right. Buyers are tired. Yeah, see that? The Billy saying the buyers are decreased. Yeah, less buyers or less buying pressure. So all that is correct. Now, let's just real quick. Let's look at the 50 puts in August, let's say. If you sold the 50 puts, right now you'd get right around, you probably get $1.41, right? Let's round down and say you collected $1.40. What that means is you would be obligating yourself to buy the stock at $50, but they're paying you $1.40 to do that. So 48.60 is what your cost basis would be. So if you wound up buying the stock, you're basically long the stock at 48.50. 48.60 rather. So again, if the stock drops down and even comes back halfway to this moving average, you'll most likely wind up taking in more of a credit if you wait just a little bit. All right. Now don't get upset at me if it goes higher. I'm just saying that the technicals, I'm interpreting the technicals saying the charts are telling you to wait. All right. All right, let's go. That's for Morgan Stanley. Thank you, Philip. All right, now. Okay, Stephen, that's your email address. Okay, not a current subscriber, interested. Okay, all right, Dominic, you're online. Take notes, and I'm gonna hold on and get those emails collected. So, all right, so Ron is putting NVAX. Ron, you didn't put what your intention is on there. I'll wait for that. I'll put the chart up, but if you can, put what your intentions are. Whoa, sell it. Well, I mean, that's what the charts immediately. I'm going to do something here that I did last time, but I want to regroup and give everyone the education on this. Notice how back here, right, earlier in the year, the stock had more or less a slight upward trend. All I did was I'm connecting some of these lows back here. Now, look at what happened in March, April, May, right? What happened is that the trend accelerates. So when you're drawing a fan line such as this, you start off with a trend. Then what you're doing is you're basically measuring the acceleration in the trend. So you take the last touch on that former trend line and you begin your newest accelerated steeper angle trend line, which is fan line number 2. Now, When you start getting over 3 fan lines, it's already a dangerous long. But watch what I could, because I could see I'm already drawing this out of my mind. Now, it's fan line number 2. Fan line number 3 begins here, last touch on the line to this low, project out. Next fan line starts at the previous low here, goes to the next touch here, see in this area, extend out. Next fan line goes to this touch, goes right here. Boom. We're already at 5 fan lines, and it gets steeper. Look, see this? How much more vertical is this stock going to go? Now, there's good news out on the stock, no doubt. But at what point does this get to be an unrealistic trend? It already is, in my opinion. And because look what's happening. The stock went higher today, but closed with a red candle, with gaps below the market here, here. Stochastic showing a negative divergence. The CCI is showing a massive negative divergence, right? Much, much higher high, much lower high. If I was trading this one, and again, maybe Rob, you're thinking about taking a short. Let's see if I can find that. Did you put a comment on that one? Oh, wow, look at that. Okay. All right, I don't see what your intention is, but I'm sure a lot of option traders right now are putting this on their watch list as a short candidate, right? Because you could play options on this one instead of spending a lot of money shorting the stock. You could just go out there and look to buy some cheap out of the money puts. Let's say you buy a 19, buy this put for $20. It's still a short-term play. But as an option trader, I'm looking to do a calendar spread on this one. A calendar spread is the way I would go, a diagonal calendar spread using the puts. And in fact, thank you. I'm going to put that on my list and as a watch list, as a possible candidate. I have to look at that, Wednesday or Thursday, see if that's a possibility. All right. So again, the charts are telling me if you're going to buy it, make sure you bring a parachute with you. It's telling us the trend is overextended, gone vertical. Volume is actually starting to drop. I didn't mention that, even though it's a red candle, that's a drop in volume. All indications, if I'm using my trader checklist, all indications are showing sell. Red candle on lower volume, sell. Wide divergence from the 20-period moving average, sell. You got gaps below the market, sell. You got the stochastics turning lower, sell. CCI turning lower, negative divergence, sell. There's really nothing on there that's telling me buy it. Okay, so be careful of that. All right, I may not be going as quickly as I could, in this rapid fire stock analysis format, but my goal is to educate people. And I put out the weekly market report and I make my comments, but obviously I'm not able to answer people's questions. For the life of me, I don't know. And this is where I need your help. If you like my weekly market report, especially after last week where I pinned every target down, nailed it to the penny. For the life of me, I can't understand, or I don't know who the 2 people are that gave it a thumbs down. I don't know if those are my competitors trying to sabotage my ratings. I don't know. If you are one of those people that gave me a thumbs down, one of the 2 people that gave me a thumbs down last week, please identify yourself. I'm not going to try to bash you, but if there's something you're not liking about the chart, please tell me. Maybe I can enlighten you about that. But the charts continue to be the best forecasting tool I've seen, and I am going to prove it to everyone, especially when we start recording all the market rebellion forecasts, because I am not going to rely on opinion to rate me in my forecasting. I want my percentage of accuracy to be out there to the world, because I want people to know that I am wrong from time to time as well. No one is 100%, no one. And I will talk about the ones that didn't go correctly with the forecast. I will, because everyone needs to know that if you're trading, you're going to be wrong. Not if, but when. And when you are wrong, you have to know how to handle the move against you. It's just as simple as that. It's all about, this market is really all about risk management than it is making profits. It's because you'll make the profits as long as you're managing risk correctly. All right. So All right, Ron, so I did the NVAX. Okay, scroll through some more emails. We did Amazon. Okay, so who was, let me go, Stephen Offner is, uh, Z, what is it, ZS. Let's take a look at this one. I'm not familiar with the stock symbol. All right, ZX. Do not have yet, but thinking about buying if it breaks resistance. Well, listen, this one, I'm not familiar with the company itself, but the technical charts are actually showing fairly good, strong signals. Now, I'm not saying it's a screaming buy, but look what's happening. You have a green candle, all right, a Marabuso, close to it. Marabuso is when it opens on the low, closes on the high. You have a little sliver of a shadow. See that little tick mark there, the little vertical, and the volume is increasing as the stock is reaching resistance. Now, I think I talked about this the month before last, where I said if you're expecting a breakout, you're going to need the volume to be increasing. And I think I used the analogy of the driver trying to drive through a brick wall. Put your crash helmet on and you got to hit the accelerator, right? You got to hit the gas pedal if you think you're going to break through the brick wall. Well, the volume is increasing. Now, with caution, I will also say that there's a gap below the market here, and the CCI is registering a slightly overbought condition. So if tomorrow the price action matches these highs, then you would expect the CCI to match the highs from back here. So if you do not have a match, or at least a match, then that's going to be considered to be a negative divergence on the CCI. You see? So when I'm looking for a buy signal, I would much rather look for stocks that have the potential to be in demand in an oversold condition with strong buy signals. See, there's lots. I'm not telling you not to buy this one, but I'm telling you, be a cautious buyer, because if you get that negative divergence on the CCI, that is telling you be quick to take your profit. This is not buy and hold and look to get a home run. You know, if you buy it at 128 on the breakout, I would say, okay, where's the next resistance area? And let me use that as a target, right? There's a weekly chart. See, the weekly chart looks a lot different than the daily chart now, doesn't it? If I would do fan lines on this one, you got a fan line here, 1, you got a fan line 2 here, you got a fan line 3 here. We're already at 3. Remember what I said, over 3 gets really risky. And again, you got to watch that. All right. So again, I don't want to talk you out of it, Stephen, but I'm saying if you do buy it and it is a breakout, then put your stop right below the breakout point, because if the breakout occurs, who can tell me what that means? Let me zoom in here. Let me zoom in. I know there's someone on the call that's listened to enough of my recordings. When resistance is broken, what happens to resistance? If resistance is broken, what does that resistance line turn into? It turns to support. That's called role reversal. Who just typed that one in? So if you're buying on the breakout, your stop needs to be right below the breakout point, because right below the breakout point is new support, right? All right, there we go. All right, I have to go to Anthony. Anthony has Tesla. Thinking of a bearish position. Well, Anthony, I'm going to tell you, without even looking at the chart, I can't believe what's happening with Tesla. I mean, Elon Musk is already the 5th richest man in the world from this company, and I can't even explain it. I cannot even explain it. I mean, I looked at the electric SUV by Tesla, thought it was pretty ugly, but I was intrigued. Enough curiosity was generated for me to look at the Ford electric vehicle, right? I'm a Ford owner. I love Ford. I'm looking to get another pickup truck, trade in my old 250 for a newer 150 because it's got good towing power and great mileage. but I'm looking at this, and now you got to look at this and shake your head when you look at the monthly. This is the monthly chart for Tesla. Now notice this. This is, Anthony, I know this is going to probably convince you to take the bearish position now, but I'm going to show you why you have to wait a little bit. This is a monthly candle chart of Tesla. You have 1, 2, 3, 4 months. Look at the price where it was just 4 months ago. It was trading $400. It's up 400% in 4 months. But notice the divergence in the CCI. This is an extreme higher high from the previous high back here, and you have a much lower high on the CCI. So I agree with you. I don't know how you're going to take a bearish position, but what I would say is play a conservative bearish position. Either do a debit put spread and have the money debit put spread, or sell a way out of the money credit call spread. Other than that, this one is a very hard one to trade in any other strategy. That's a low risk strategy, because even the diagonal spreads are going to be expensive on this one. So again, look at that. It's gone vertical. This looks more of a diagram of the last SpaceX launch than it does of Tesla, the stock, right? And like SpaceX, right? The rockets go up and they get retrieved. They come down. I'm not saying it's pulling back right away, but let me give you one more thing, all right? If you are thinking about taking a short position, let me give you an idea of how to draw your targets, all right? I'm going to go to drawings. I'm going to go to the Fibonacci retracements here. The way to do this, for those that are brand new, almost every charting platform has the Fibonacci's on there. You start from this low and you draw it up to the last previous high. So you click your mouse, this opens like an accordion, and you drop it. The 50% mark is usually what we would expect as a target, right? So what is that price? $1,076.33 per share. That is very, very close to a role reversal support level. So if you're going to take a short position, understand there's gaps below the market, that's bearish. Wide divergence from the moving average, that's bearish. Indicators are rolling over, bearish. This is a weekly chart, so it's still too early to read the volume. But I would guess that this week's volume is going to be lower than last week's volume, which would make it bearish. So it might be better for you to wait towards the end of the week to make sure that that volume closes lower before taking any short position. And again, Anthony, you got to trade this one in a conservative way. Don't go long shot on this one, because it could really hurt you there. All right. So Home Depot, Colleen, we still have time for a couple more. So keep typing in your stock symbols there. Okay. This is recorded, by the way. All right. So our members will get a copy of the recording. All right. Now, Colleen Lawrence is looking. So you love HD. Right? But it seems to be stuck in a narrow trading range right now. Well, yes and no. Right now, again, I'm starting with the weekly chart only because we have the weekly chart up. Again, look at the negative let me get rid of that. I don't want Fibonacci numbers on my I don't want Fibonacci numbers on the CCI. I got to get that back to my trend line. Right, there we go. Notice this high compared to this high compared to this high, and I'm stretching it out. See this? Notice the sequence of higher highs here. This, again, is an extreme price divergence from the CCI, all right, in comparison. That's the weekly chart. Now I'm switching to a daily chart, leaving those lines up there. Now, today we have a green candle, but look at the CCI. It's going lower, right? It's only down 21 cents, but it's not at a point where I'm going to say it's a screaming sale or a screaming short. It looks like a screaming short on the weekly chart, but if you're going to play this one, all right, you would also use options, because it's a fairly expensive stock. Colleen, are you trading options primarily? Typing that in and I'll wait for your answer. I know there's that delay. All right, are you using options? Just put a yes or no. Yes, you are. Okay. All right, so Colleen, again, this one could be a good candidate for a diagonal spread because the long puts, and for those that don't trade options, forgive me, but it might intrigue you enough to start learning options, all right? I would still go out to January 2022 on the chain. So I would buy the leaps. I would go out to January 2022. I would look to buy an in the money. I would look to buy an in the money put. All right. And I would probably go to 280. Right. You split that market, you could probably buy those for 49.5. The general rule of thumb when you're buying a leap is to buy the leap that's in the money and then try to sell an out of the money for at least 10% of what you'd spend on the leap. So in other words, you're looking to pay down the cost basis by 10%. Whether or not this is a good trade depends on whether or not I could get 10% on that. So if I'm spending 49.5, I want to be able to get at least 495 on whatever option I'm selling. So I go to August and see if there's any options that are out of the money where I can collect 495. And there is. Look at that. If I buy the in the money leap, I can sell the out of the money put for $5, maybe 5.5. So that would be the play, because even in an up market, you could make money on that put spread. I know it's a bearish strategy, but it's forgiving enough to be able to make money even if the stock goes against you. That's how I would play Home Depot. All right. Now you could also look at Lowe's, LOW, right? There's a stock that's trading in line with Home Depot. It's a similar industry, and you could probably compare to see, am I able to get out of the monies for the same amount? Yeah, there's good premium there as well. So, Colleen, that's the way I would trade it. And again, I would wait for a more well-defined sell-off. I remember you were in Miami. I would employ some of the strategies we talked about when we were down there for that workshop. Okay. All right. Let's see. I'm gonna have to scroll down to the bottom because all the emails and questions have pushed that down. All right. Let's see. Paul. All right. Welcome, Paul. WKS. WKHS. WKHS. Oh, let's get that in. WKHS. All right, so you bought at 265 in early June. All right, let's look at this one. Congratulations. Now, what's happening here is a major buy signal, but be careful. I want to make sure that you're understanding exactly what I'm talking about. The major buy signal comes in the form of the price action being a bullish engulfing pattern here today on pretty high volume. All right. So that is, if that's all we looked at, that's a buy signal. So what I would expect is that stock to rally. Now, the fact that you bought it at $2.65 doesn't mean you could just hold it forever and risk the profits that you have built in. What I would do is, again, let me ask you a question. Do you trade options? Yes or no? That's all you need to say. Do you trade options? Paul, I'll wait for your answer there. And do you trade options? Waiting. Yes. Okay. What I would do on this one is I would sell out of the stock. Again, this is just a strategy you can think about, not a strong recommendation or anything. I'm just giving you options, or I should say choices, that can replace the stock position. I would take the profit on the stock, period. Take the money off the table and then take a portion of those profits and buy leaps with it. Now we have to see if there's any leaps that are liquid enough to do that, right? How far out can you go? Well, we don't give you too many leap choices, but what you could do is buy the in the money $14 calls here. You'd have to split that market. So you remember, you're selling the stock for $16, taking your profit, and then you're taking $6.50 of that profit, right? More or less leaving you with the $10 profit in the bank. And you're putting some of that profit to risk on the leap, right? Or the January call, I should say. If the stock starts going up, guess what? You've picked up more leverage without increasing the risk. You follow? If you're taking profits off the table, they can't take that from you. You've taken it. It's like you hitting it big on the craps table, and now you're letting some of that profit, right? You're letting some of that profit ride. If that leap, or I keep calling it leap because it's a January, it's not technically a leap, but if that call now goes to zero, you still have $10 of profit in the bank, and you can laugh at all the sellers that tried to hurt you because they didn't, right? So now, part two of that is, if you buy that January call and it goes up, then you could sell $20 calls against a long call. That's an intermediate strategy. I don't want to confuse you, and I certainly don't want to confuse those who have little knowledge of options, but that's why I'm so busy. I'm taking people from really basic option strategy, and I'm moving them and advancing them through the ranks so that they learn how to manage risk and take profits at the same time. All right. Just looked at the clock. Sorry, we didn't run out of questions, didn't run out of content, didn't run out of stock symbols. We just ran out of time. Stay tuned. There's going to be more announcements coming down the pipeline. And I will, again, I will absolutely collect all the emails from those who have given them to me. And we'll have someone from our team give you a call. I can't guarantee when, but they will most likely give you a call sometime this week. And again, watch for the recording. Our members will post that out. You'll get a recording. And I want everyone to keep me accountable. Hold me accountable to this report. What I say to tell people is, after you get the recording, put it on your calendar to go listen to it again 2 weeks from now and go through each one of the forecasts so you can see how the technicals panned out. Okay. And that's the way we learn about technical analysis, by verifying the accuracy. All right, folks, have a good night. We'll talk to you soon. So long.